after being rudely interrupted by some Canva limitations. And this will be part 3 of what's turned out to be a mini-series on risks when trading Forex. In part 2, we finished up with correlation risks, and we'll keep things short here and move straight into talking about trend following. You might not think that there are underlying risks with trend following, however there are, but it's a bit more indirectly. And this comes down to the behavior of trend following systems. I'll do a video later on why trend following is the way to go for CFDs. It's what we are mostly going to be focusing on, except for indices, because mean reversion's pretty dope on indices. But for now, I've done up a bit of a dirty chart on ChatGPT highlighting the general differences between trend following and mean reversion. It's pretty simple stuff, but the important thing to focus on here is the lower win rate and higher risk to reward ratio. Oh, that's so hard to say. Because the trend following systems are prone to underperforming in general until things start moving, and when things move, they win pretty big. And if you diversify your trend following systems out enough, you can lessen the effect of future stagnations and drawdowns. However, you will still get strings of losses, which can be brutal. These strings of wins and losses are reflected by a metric called the Z-score, and this measures how many standard deviations away from the mean your average winning or losing streak is. And we can see how streaky a portfolio of trend following systems is with this. And generally, trend following systems have a pretty high Z-score, which really reflects this streakiness. As with pretty much everything, diversification is your weapon against this. Diversify out and you can lower your streakiness. And you can use this to your advantage a little bit. If you're in a period of drawdown and your Z-score is really quite stretched towards the extreme ends from your historical data, you can use this as a way of timing when to top up your trading account, hopefully when it's at a turnaround point. I did promise to keep this one short, so we will move on to the last topic, which is overfitting risks. And really this could be a thesis on its own. Our number one battle as developers on machine learning software is to try and reduce the amount of overfitting in pretty much every facet of what we do, because every little setting that we will be tweaking with has the potential to contribute to overfitting. And we aren't here to try and build perfect strategies. We are trying to develop strategies that are robust enough to survive under future live trading conditions due to the exploitation of some underlying market edge. And to state the obvious with this, if you end up launching an overfit strategy live, or what could be a false positive trading hypothesis, you run the risk of that strategy failing pretty heavily under live trading conditions. Or if you are lucky, it'll instead have a significantly reduced performance. As a very simplified example, I've just gone and built 600 or so strategies, pretty simple strategies on Euro USD on the hourly. And the data that they've been trained on was from 2003 up until 2017. And you can see the equity curves in general look really nice because this is the training data segment. And what we'll do is we'll do a little exercise and see what happens when we run these systems on data that hasn't been encountered before on the Euro USD. So I've gone and run them from 2017 up until 2025 on recent data. And let's see what happens to their performance. So you can see all of the sudden they are hitting some major patches of stagnation, and in some cases they just absolutely fall off a cliff. And this is the overfitting coming into effect, and then when it hits data that hasn't been seen, yeah, yuck. And of these 575 strategies that were built, only 4% of them passed on data that hadn't been seen, and that was based on a performance with a profit factor greater than or equal to 1.1. Luckily, within Strategy Quant X, we have an arsenal of methods that we can use to try and help reduce our risk of overfitting, and this comes in the form of robustness tests. And these are statistical stress tests that can help eliminate overfit strategies to try and increase the percentage of strategies that have some form of edge that pass on data that hasn't been seen. And as an example, if I was to run my suite of custom robustness tests on, say, 10,000 or so of those Euro-USD strategies, on a percentage basis, the number of strategies that would have passed that 1.1 profit factor metric on unseen data would have shown a decent increase, because a lot of the rubbish strategies would have been thrown out, leaving those that have a higher chance of surviving on unseen data to be tested. And these tests will ultimately reduce the risk of your funnel strategies failing when you run them live. And a big part of this series will be focusing on robustness tests and building your own automated workflow so that you can have Strategy Quant X running while you're out and about doing other things. So we'll leave it with that for now. Hope you enjoyed our rundown on risks within the Forex world. Risk will be an ongoing theme during this channel, so this definitely won't be the end of it. Don't forget to like and subscribe if you are getting something out of this. It helps make the videos visible to others with the way the YouTube algo works for startups. So until next time, ciao.